Hey everyone, it's Arash Adnani from privateplacements.com, where we're looking at investment opportunities and private placements every day, all day. We love looking at natural resources, and with me today are Sam Broom and Eric Angeli from Sprott. More specifically, Sam and Eric are with Sprott's Resource Exploration Development Private Placement Fund. It's basically a private placement fund that focuses on the natural resource space. We've done some interviews with the team before. We wanted to get an update from the guys and see what's going on and what they're seeing from Sprott's perspective. Sam and Eric, really good to see you guys. Thanks for joining me.
Yeah, likewise. Thanks for having us on, Arash.
And
thanks for having us.
Yeah, and I think the time of this interview is really timely because when I look at our platform and I'm looking at the number of deal flow, the private placement market for resource deals, it's absolutely booming. But when I say booming, I don't mean, prices are shooting up. I mean, there's a lot of deals. There's a lot of activity. A lot of companies are out there raising money. Now, obviously, not all of these companies are good opportunities, but there's action and there's activity. And so before we get started, and we're going to kind of dig into a lot of what's going on, can I get a refresher from you guys as far as what the Sprott RED LP is up to and kind of what's been done since the last time we spoke?
Sure. Well, the RED LP, as we call it, Resource Exploration and Development, is sort of a one-stop shop that we've rolled out on offer to our clients to allow them the ability to participate in private placements and early stage, high risk, high reward opportunities that would have otherwise been difficult for them to access a la carte on their own. Sprott manages, I think, 20 some odd $1 billion in AUM, AUA, and some of it's active, some of it's passive, some of it's in the physical metal trusts, et cetera. And we have all kinds of managed account portfolios that give you exposure to broad basket of commodities, specific commodity investment funds, but the ability to do private placements was sort of an area that was being left kind of as a void. And we thought this is a way to pool our client capital so that we can transact efficiently and effectively and kind of leverage the Sprott's negotiating power in a single vehicle that could access better deals, price those deals, on terms we felt favorable to our clients, to our LPs, and to then handle the back end, ledger removal, warrant exercise, actually trading the stocks, and following on with these investments to make sure that management teams are spending our money wisely, and to kind of engage with them to make sure they're keeping track with their various milestones. So RED LP is really just a vehicle that's complementary to the rest of the investment products that Sprott has on offer, but it's kind of thought of as the high risk, high reward, arm of the organization. We launched it in November 2021, so we're 18 months in at this point, and it's been, regardless of performance, in my opinion, a resounding success, because we've onboarded clients in a manner that was efficient and effective for them to basically carve out this section of their portfolio that allows us to pursue these types of high risk, high reward opportunities. And just in that context, I'm delighted to be able to sit here and present it to people. Twice a year, we offer it up to new investors. So at the end of June and at the end of December, we allow for new investors, new LPs to join. The minimum investment size is $250,000 US. And so far, we've called up 60% of client capital, which is to say we set it up to be a callable fund because we didn't want to have a pile of money on day one where we're then looking out and saying, well, what deals are we going to do today? Where suddenly you're a hammer and everything's looking like a nail. We set it up to be callable. Let's call in the money as needed. Let's start slow, start small. Let's put our name out there. Let issuers know that we're allocators of capital, and show us their deal flow. Show us what opportunities we ought to be looking at. And slowly but steadily, we've been putting it to work. So yeah, it's been a resounding success, in my opinion, just on that context.
And so in the 18 months since launch, off the top of your head, do you know how many deals you guys have invested in?
Yeah, preparing the Q1 quarterly for our LPs now. We've done 24 deals. We've probably looked at, I don't know, Sam, what do you say, 100 in the last 18 months?
At least, yeah.
Not a week goes by that we're not looking at something, taking a call with a management team, being shown a private placement opportunity from a bank, an investment banking desk. We see a lot of deal flow. We say no a lot, which is to say, the more we get to see, the more we get to say no. But in turn, we'll also have the ability to reflect in. And so, yeah, we've done 24 deals now. Not all have been straight private placements. Some have been private placements that we tried to get access to, couldn't, and saw an opportunity after the secondary market, after the placement closed in the secondary market to accumulate, on market. So, we're ultimately looking to get a position for our fund in early stage companies that we think have the potential to be future mines.
That's you actually referenced something that's really important, and it's, I think, one of the hardest thing about investing in private placements. It's getting allocation. Like you might do your homework, you might just cross all the T's and dot all the I's, and when it's time to maybe call the company and express interest and find out more, you'll learn that there's no way you're getting in. It's impossible. And so to hear that there's been cases where you guys haven't been able to get into something, let's say a deal that you've liked, that leaves the individual investors at a complete disadvantage. And really, I say this from experience as well. Like I look at deals every day. My kind of routine for making any decision on investing myself, it's like a weekly process. And I noticed that with a lot of companies, if you really like the deal, it's not guaranteed that you can get in. You might have to, get an introduction through a mutual contact, things like that. So that access and that ability to get a foot in the door and have the opportunity to invest is huge. I wanted to find out about something, and this was really interesting to me because before we started recording, we're just talking about different commodities, and every day there's headlines and news that either makes a commodity seem more attractive or kind of makes you question it a little bit, perhaps. And one thing you guys said, which is interesting to me, because I'm agnostic when it comes to sectors, but you guys mentioned that you're agnostic when it comes to commodities. And what you meant by that is you really look at investments on a deal by deal, company by company basis. Can you walk me through how that looks and how you guys actually assess a deal that way?
Yeah, Sam, you want to?
Yeah, sure. I mean, as we were discussing before the call, a lot of investors in this space tend to, operate top down, where they look for a commodity they feel they're bullish on. It's a lot easier to assess or to feel like you're doing diligent analysis at a commodity level. Not many people out there have the technical expertise to go in and do a deep dive on a company on a technical level and figure out whether that company's assets has merit, right? There's not too many groups out there with, world-class geologists, mining engineers, all these sort of technical personnel that have the skills to do the analysis justice. So where we feel we have an advantage is we do have a world-class team behind us. And, regardless of market, finding these rare world-class opportunities is, in our opinion, the best way to make money across various market regimes. And we all know that there are dozens and dozens of different people out there, hundreds of people out there making predictions on commodity price. Most of them end up being wrong. It's a very, very hard thing to do, to pick the macro with any degree of accuracy. So we feel that our competitive advantage is going out there and identifying those very rare world-class assets that, as Eric said, are likely to end up becoming a mine, but not only become a mine, but have the correct or the right set of fundamentals backing them, whether it be the management teams, incentives, the corporate structure, the ability to market and get their cost of capital down through, adequate levels of promotion and things like that. Is a whole host of things that we look at when we're assessing a deal flow or a potential deal that go into our decision-making process. And in our experience, starting from the bottom up rather than the top down has yielded the best results no matter the market. We've had situations where, we've been in a terrible market and a unique opportunity has come up that's ended up making decent money even in a bad market. You're not going to get that necessarily if you focus top down. And so that's why we tend to focus, bottom up, company specific.
Yeah, that makes total sense, because I think when you're following the bottom down approach, a lot of times what happens is that you're competing with a lot of people, because that seems to be kind of the more mainstream way. I think if you're looking at companies individually and maybe looking at the commodity secondary, you might find yourself in situations where you got your pick of the deal per se. You're not competing as much. What is the breakdown of inbound versus outbound when you're looking at deal flow? Meaning, are companies just hitting you guys up, looking to get a meeting and looking to get you to invest, or are you guys following deals and reaching out to companies yourselves in more of an outbound fashion?
Good question. It's certainly a mix. We take a lot of calls, and we have a few different ways of kind of having first pass screenings. I would say that it's more us pursuing companies because we like the project and we think the project will fit what we believe to be, lowest quartile operating costs of that commodity when it goes into production. And we like to think about our investments as, when, not if type of investments. This will be a mine. I love it when, our in-house geo says that one sentence in a research note: this will be a mine. You need to own that. You need to own that. And that's kind of gets back to your question about, or your comment about not getting into this deal. Well, if you have a setup where you have a good management team that has high insider ownership, right? They're partners in that business. They don't want to take an unnecessary amount of dilution. So they might limit their deal. Hey, we only need 10. We're only going to take 10 million. Even though there's demand for 20 million, we're only going to take 10 because we own a lot of stock internally. We know that our project is going to be a mine. We think that it's going to continue to unlock and keep advancing, and they want to limit dilution. Those are the types of companies that we want to be buying on market after the deal closes, because they have the right sense about what it takes to get a project through to the goal line. But yeah, we tend to be more commodity agnostic, and so we will actively engage with and reach out to companies that we see as having really high quality projects, and understand a year out, hey, here's how much money they're going to spend over the next year. Here's how much they have now. Around third quarter, they're going to need to start raising money because by fourth quarter they're going to be broke. And these companies don't want to go right to the end of the line. when the market knows you need to raise money, it's kind of too late. Then you're playing chicken with the market. So these companies will want to raise a little bit ahead of that. And yeah, we're engaging with them to say, hey, we like what you guys are doing. When you're ready to raise money, give us a call. Keep us on your register. And so sometimes they're returning our calls, or sometimes, we're being shown a deal from an investment banking desk that, we knows we have an appetite for that type of stock or that kind of an opportunity.
And so, walk me through that. So obviously the project asset is very important. Is there, like, obviously you guys got a massive team and you have access to a lot of resources, both intellectual and just databases of project information. Are there specific regions, zones, past producing mines that you guys have in your database, and you're aware of projects from that area that are owned by different companies? And is that part of the approach? Because that's I wouldn't be. I wouldn't be able to do that.
I see where you're going with this question. Sam can speak to this. Some of our best wins have come from a management team we know securing a project that was in private hands, or in the bowels of a major miner that was never seeing the light of day. And dusting off some of those old projects and giving them a fresh pass with fresh capital and a fresh set of geologic eyes. Yeah, that can be, a huge opportunity, especially if you can get positioned early.
Yeah. So and Sam, you're a geologist, right?
Correct. Yeah, geologist. I have a degree in geology. Yeah, I used to work in the mining engineering space in Aussie prior to joining Sprott.
So are there cases where there's an asset that you guys like or you love, but you don't love either the structure or you don't love the management team or both? Do you still get in because the asset is that good, or do you have to take a pass on it because it's like, man, like this management team can actually ruin this? I mean, not ruin the asset, but they can ruin the opportunity by diluting or, just cutting a bad deal or whatever it may be?
I think a lot of it, it's going to be very rare where literally every star aligns, but the majority of the stars have to align for us to be interested, right? And I mean, I'm just thinking of what you just said there. I mean, we had a recent example late last year where there was a mine, an operating producer actually that we invested in that, I'll put it in the dog category, that had been a perennial disappointer for years and years and years. And what had changed that made us, change our tune and give them some money, basically, was a management change, right? Like the old management got the ouster, the new management came in who we liked. We had a meeting set up with the management. They really impressed us with their new approach. They came into this mining situation, completely changed the mining method, so we could see a path forward that would, turn this mine around. And the combination of new management, new approach, moved this specific opportunity from being a hard no to a name we were willing to put a moderate amount of the fund's capital into, because we could see a step change. So there are a whole host of different scenarios that result in us giving a company money where we may not previously have. Change in management is a huge one, because I would almost rather give an A+ management team with a B grade asset money over a C- management team with a good asset. But management, it is cliche, but management is so important in this game. It really, really is.
What about structure? What if it's a good asset? Like I see this a lot. Like I'll see a deal, and it's maybe the financing price is, it's not too bad. It's like 20, 30 cents. Project looks interesting, but they got way too many shares out. And so in my head, I'm kind of start doing the math of like, what would it take for this thing to move? Are they going to do rollback, things like that? Do you guys have kind of thresholds in place for a structure of the company, the cap structure of the company, and whether it's healthy and it will allow you to see the gains that you need to see?
Yeah, it's interesting because I spent my time cutting my teeth in the space in Aussie, where it's quite normal to have 1 billion shares outstanding, right?
I've seen that with the Aussie stocks. Yeah.
They seem to love buying stock for a few cents and buying 1 million shares and feeling like they're big time. But the share structure is important. At the end of the day, though, it's probably more important for us to look forward and seeing, is there going to be future dilution? You know what I mean? I mean, if a company has raised enough capital, has a 2-year runway, they're doing exciting things. If they've got 1 billion shares outstanding, and we feel like we're going to have our unanswered question answered within that 2 years, it's probably not going to matter too much to me, unless I think for some reason there's a whole bunch of sloppy shareholders there that are just waiting for the first opportunity to blow out their shares, or there's a big pile of escrow shares about to come off escrow that we know is almost certainly going to hit the market or something like that. That might change my tune. But share structure in itself is important, but you've got to put it in context and look at what's going on behind the scenes with that share structure.
Does the fund ever take advantage of the sort of liquidity events where if there's going to be pressure on the stock with some sort of like escrow removal, and you're going to get a better deal if you just buy on the open market, will you take advantage of scenarios like that?
Yeah, I mean, I'm just thinking last year, during the depths of last year, for example, right, there was a company we like in the silver space that got deleted from the GDX, and there was a whole bunch of index selling pressure right as silver was getting beat up. And we did step in the market and take advantage of that. I like to call it non-fundamental selling. There's a seller in the market that's not selling for any specific reasons. There's nothing wrong with the company. It's an index deletion. There was like you said, there was some escrowed shares that someone's up 10x on that they're just blowing out at whatever price because it doesn't matter. I mean, those are literally precisely the type of opportunities that we do look for. And those aren't specifically related to private placements. Obviously, that's more of an on-market type opportunity, but we did give ourselves the flexibility in this fund to make the most of those kind of opportunities when they arise. And we did last year, primarily, June, July, August, September, when things were really looking beat up. We did step into the market and accumulate.
Yeah, and to Sam's point, it was in this specific example, we had reflected into a private placement several months earlier at 20%, 30% higher price, and only received 2/3 of the fill that we had put our hand in for, put our arm up for. Why wouldn't we go in and buy it at a discount with, on market shares where they're free trading there and after? It's a great opportunity. We don't necessarily see this fund as just a slush fund to go out and trade whatever we want to trade in the market, but we have, because we have specific mandates. We are looking for private placements. That is our mandate. That really is the best way to get positioned into most of these stocks. You get your fill all in one ticket, but you can't stare that gift horse in the mouth for too long. When you see these things, just an index puking out volume of the stock you like, they've got 50-60 million dollars cash in the bank now. Why wouldn't you buy it at a 25% discount? As Rick used to say, you loved it at $1, you have to love it at 70 cents. It's true. It's the same stock. Why wouldn't you buy it, right?
Yeah, that's I think exactly the point, and also the flexibility to be able to do both.
Yeah,
is really important. And furthermore, I mean, listen, like obviously we invest in private placements, and we do quite a bit, but we also buy in the open market. But private placement investing, at the end of the day, I find it's still so niche that it's still a bit of a foreign concept to a lot of people. They kind of know that they should know about it, and they should maybe invest in it and be involved, or at least know what's going on, but they don't know the true reason. So you touched on one of the points, which is, well, heck, you can get your order filled in one transaction, which is great. And by the way, just a reminder to people, some of these deals we're talking about, like really good luck getting your order filled in the open market. Like it's going to be work. It's possible, but it's going to be work. So Eric, I mean, listen, you're a veteran of the game. Can you kind of list some of the other benefits and reasons why your guys' fund is private placement focused?
Sure.
We're investing in private placements.
You oftentimes get favorable terms. Private placements, some regularly come with warrants, and the earlier the stage, the higher the risk, the better the terms are for a check writer. The best projects, as they get moved along, typically don't need to keep offering up these sweetheart deals, full 5-year Rick warrant, as we like to call it around here. But they still need the money as well, and sometimes they can bring in institutions to fill those tickets, those big chunkier checks. But the further down the market capitalization and the further up you go in the risk spectrum, the more attractive the terms are that you can negotiate to be the lead ticket. And when I say that is, we might approach an issuer and say, okay, we have an idea that you need I'm just using hypotheticals, $5 million for your upcoming summer drill program. We like this. We would like to be your lead cornerstone ticket on your private placement at for $1 million. But here's our terms. So if we're the opening bid, we set the terms, and then they can go and build a book around that and say, hey, I think I can ring fence $5 million on these terms. And so the warrants, for your listeners, and I'm sure they already are well aware of this, warrants give you the right to buy additional shares at a previously locked in price for a set period of time, and they can be huge when you get a good discovery in the right commodity market, and you've got warrants. They turn a 10-bagger into a 15-bagger, that kind of thing. They don't always come with it. And to your sort of point about people should be doing more of this, sometimes there's like a financial illiteracy that exists here, where people need, we call these companies issuers for a reason, because they issue stock out of their treasury. They don't produce anything yet. They're explorers. They're trying to develop a deposit that one day will produce.
They sell stock.
They sell stock to the market. Yeah, that's their business. They're issuers. And so we think about our investment as, will we see value be added, or will we see dilution, erase the value that's being added? What's going to win? Value add versus dilution. And if we think that the scales are tipped on the value add side, then we would care. If we look at a management team that has a track record of doing sloppy deals, wasting the money, coming back to the market again at successively lower and lower share prices, and then you look at the share structure and you go, oh, well, that's why they don't own any stock. Management doesn't have any insider ownership. That's kind of a non-starter. We wouldn't even, even if they had a great project, we wouldn't necessarily participate in that deal because management has no skin in the game.
Yeah.
Right? So these companies that don't produce anything, they have to come to the market for their capital needs to pay their overhead, their listing fees, their auditing fees. But if we're talking about exploration, it's expensive to drill these holes. This is expensive exploration programs, depending on where in the world you're operating, to try and make a discovery and show the market, paint the picture of blue sky potential for what this deposit could look like and could eventually be one day. That's how these mines become mines, is through high risk exploration drilling like this.
So one of the beauties of what you just said is the ability to originate the deals, and you can do that because you kind of have the ability to know when a company or an issuer could be going to market, and so you can preemptively have that conversation. But that allows you to do something that's really important, and that's to dictate the terms of the deal, to kind of be the lead order. And so this kind of brings me to a question that really ruffles my feathers, and that's the financing price. And so what I typically see some companies do, which really annoys me, is leading up to the announcement date, if you look at the activity of the stock from, let's say, like a month out, you can see some manipulating going on with companies maybe doing some promo to get the price up just so they can raise at a higher price. And it's just kind of like, hey man, like, we can't do that. This is a 20-cent stock, not a 25-cent stock, and that 5 cents is going to make a difference.
Yeah.
Do you ever, like, other than asking for rec warrants, which is a 5-year warrant, everyone, what's the biggest kind of sticking point in these deal term negotiations? Is it financing price and kind of like really getting the right price that's fair to the market the way to go, or is it pretty black and white with the metrics and formulas that you guys use and a lot of other companies use?
You just got to take the company's valuation at the time the deal goes up based on the terms they present you, and ask yourself, does the risk reward look attractive at that point in time? And if like you said, I mean, it happens all the time, right? They've done a big promo tour, or worse, and the stock's just ramped up 50% on no news. Odds are we're probably going to pass on that situation. You know what I mean? It comes back to the company, the valuation. Do we like the asset at this price? If the answer is no, because I've just pumped it up, we're probably just not going to play. And you have to be diligent. You have to be able to say no. Like Eric said, I don't know, at least 10 no's for every yes. Probably more, probably significantly more, in terms of number of deals we're shown versus the number of deals we take on. So, that's probably always going to exist in the industry. You've just got to be aware of it, and you've just got to factor it into your decision-making process when you're making the decision to participate or not.
I think you have to, like, your ability to say no to deals and turn deals down is going to be one of the most important skills that you develop as an investor in these deals. Because when I look at these deals, and again, I'm looking at everything, so I'm looking outside of mining as well. They're like a lot of these deals, as Marin likes to call them, Marin Katusa likes to call them, they're financially transmitted diseases. Like you cannot touch them. They look awful. Like you need to just like get away and like don't even think about it. The thing that is really clear and obvious, and this sounds like a shameless plug. It is a plug, but it's also truth. Is that in order to be a successful private placement investor, you need a lot of things. Okay. And that includes access, that includes resources to assess these deals, to have the technical ability to look at the projects, to have the relationships, all these things. And so having a fund like you guys have, it plays to that perfectly. It does all the heavy lifting, and it uncomplicates private placement investing for people. And so the obvious question is like, well, okay, well, why isn't everyone investing in private placements? But it's not as straightforward. For you guys' fund, at least, there are specific requirements. I think the main one is that the investor needs to be accredited, which you have to be accredited anyway if you're investing in a private placement. What's about Canada and US definitions, I think slightly different. What's the US definition for an accredited investor?
There's a couple different definitions. Million plus net worth, but having, to be a member of our fund, there's a couple of different ways to qualify. And
okay, so tell me that maybe.
Well, yeah, so we have we operate two funds in tandem, side by side with one another. One is a limited partner fund, and one for LPs, and one is for qualified purchasers. So depending on your net worth, you're eligible for either one fund structure or the other fund structure. It all comes down to so the SEC has one fund structure is the limited partner fund structure, where you can only have 99 limited partners if they are accredited. If they
so that's a million net worth or 200,000.
Yeah, or
annual income.
Yeah, 200,000 annual income. There's a couple different ways to qualify it. But if you are eligible for a qualified purchaser fund, a QP, where you have a $5 million net worth, you're one leg up in terms of the SEC allows you to manage a fund of for 2,000 people, but everybody in that fund needs to qualify as a $5 million net worth. So we have these two funds that operate sort of side by side, and we think about it in the context of one fund. You know, when we reflect in $1 million for a deal, it just gets allocated between the two on a pro rata basis. But it ultimately means that we're an evergreen fund. Once we hit 99 investors, we weren't closed off to new investors. We have plenty of spots in the LP fund, and we have plenty of spots in the QP fund. Does that make sense?
So just to simplify what you just said, Eric, at the moment we have both slots available for accredited investors, so $1 million net worth, and for the QP fund, which is $5 million net worth. It is likely that the limited partner fund will fill up first, obviously.
Sure,
99 slots versus
at
2,000.
some point, yeah, that's logical,
Yeah, I mean, the last fund we did hit the 99 LP maximum within about 2 years of its existence. So,
and
that may end up happening.
And there's a minimum investment, right?
Yeah, 250K. And that's kind of to your question of like, why isn't everybody doing this? Why isn't everybody investing in this fund? That's a big ticket for a lot of people, and it's set at that level because we want to kind of self-select, you know, who's eligible for this fund. We don't want hot money that wants to be in and think about liquidity 6 months or a year from now. There's a 1-year lockup after which, you know, there's liquidity features on the fund, but we really want for our investors to think about this with like the earliest 3 to 5 year money, because these things take time to mature. And the best wins we've delivered for our clients have come in that 5 to 7 year window, where you can be early into a new discovery, ride it through the development stages into production and or takeover. And you can see those 10 baggers, they do happen, but they don't necessarily happen in a 6-month time frame, you know, unless you
got to be patient. You got to be patient. It takes time to build these things.
So we have a deliberately high minimum in that regard. Yeah.
And you've got to be willing to sit through some cycles, right? I mean, everyone last year, for example, right? There was a pretty nasty period last year, which actually lended itself in our favor because we were in allocation mode. But you really do need to take a long-term approach if you're coming into this fund.
Are there restrictions to where the investors can be based out of? So I know US obviously is okay. Is Canada okay?
Canada's okay. Australia's okay. Most of the world is okay. Europe, we have some issues with regards to reverse solicitation rules that we'd have to follow there. So
reverse solicitation. Okay,
I don't know, Sam, you want to chime in on that one?
It's always a little murky. You'd have to put the compliance guys on that one, but basically,
the EU has rules where we can't go and solicit European investors.
Yeah,
but
if you come to us, if you come to us and prove that you found out externally about the fund, we're fine. But we just can't market in Europe.
Okay, that makes sense. Okay, let's I want to ask you guys. I know you said that we look at deals, or you look at deals on a company basis. It's not a commodity play, but listen, we're talking about investing in natural resource companies, so it's always fun to talk about the commodities. One, you know, always try to kind of look to see you can catch yourself in echo chambers, okay, as an investor, okay, and it can get dangerous, okay, and so the gold echo chamber right now is that, okay, well, you know, we finally got $2,000 gold, although it's, you know, it's trading below that, but let's, you know, we're in the $2,000 range, and it's nice, and everyone feels kind of vindicated that it's finally here. But you know, gold stocks ain't really acting like gold's at $2,000. They're lagging. There's not enough action, and you know, some people say, well, it's because the generalists aren't coming in, whatever it may be. You guys, based on what you've told me, I don't think you care. In fact, you like that gold stocks are probably still cheap, but why do you think that they haven't moved? Like, people were expecting a surge in precious metals stocks that hasn't happened.
Yeah. I think you can actually make a pretty logical reason for why, you know, there's a big disconnect between even a year ago, right? Gold was at just after the Russian invasion, gold hit, you know, basically hit what was it, 2070. The GDX, for example, was, you know, 10-15% higher than where it is today. And then we had one of the biggest inflationary pulses in the last 50 years, right? And based on the data we have, I mean, gold mining companies' all-in sustaining costs were up between 13 to 15% during 2022. So with gold at the same price, to achieve the same margins you were achieving a year ago pre that big inflationary spike, you've got to have gold at $2,300 just to be generating the same returns, right? So in my opinion, there's a very logical reason why those mining companies are still trading below where they were at the same gold price a year ago. What we really want to see is you want to see that margin expansion, right? And I think it's coming. I mean, again, we don't like to make predictions too much about the gold price, but I would be surprised if in the next year or two we don't see that sort of environment where, you know, like almost like that 2020 style environment where input costs like oil were flat to down and gold was going through the roof. So I think it's coming. But again, to me, there's a logical reason why those equities are lagging at the moment. Do you have anything to add there?
Yeah, I think it just comes down to fund flows, as in we haven't seen investors believe, to Sam's point, that the margins are believable. Like we need to see the generalist investor think, I need to have some gold equity exposure in my portfolio and make a conscious allocation to that sector. If they're not doing that, then you're not going to see fund flows, you know, come in. We all are in this echo chamber. We all own gold stocks. And we're wondering, why are more people coming in and buying our gold stocks? We need new money, fresh capital to come in and see inflows. So when we talk with institutional investors, and we can ask them, so how's fund flows doing? Are you guys getting inflows into your funds? And they'll say, you know, little trickles here and there. I think it speaks to risk assets. You know, we're still in a risk off moment, it feels like, in the market. Despite the gold pulse higher, I still feel like there's a lot of people that are stepping back and looking at the global macro, you know, with rates where they are, and thinking, what's Powell going to do? I mean, this one guy is dictating so much of what people's appetite for risk is going to look like, and there's no shortage of, you know, prognostications about, you know, recessions and depressions and bank runs and this, that, and the other thing. And that keeps risk capital out of the game and on the sidelines. And it can be of benefit to us as allocators, because we can look at this and say, yeah, okay, but we're going to see a reversion to the mean. And I'm a big believer in reversions to the mean. Like when commodities are, you know, they do this cycle, and you can just track this median line, and okay, we're up here. Forget that everybody wants for things to go higher. It likely goes lower. It likely reverts back to the mean. I know, hey, we're down here. It's looking really terrible, but it probably reverts back to the mean. That's the way I think about things. And you know, when you make mention of like, hey, we're commodity agnostic, I only think about it as commodity agnostic because I try to remove the bias that is so hard to like divorce yourself from. If I'm a copper bull, I think, you know, I drink the you know, future facing metal Kool-Aid, and I think copper's going to $10 a pound because I've heard Robert Friedland talk, and he's just got me hot to trot for copper. And I go buy a bunch of copper stocks. I now have an inherent bias, and I can't step back from that. So do I sell a stock that's gone up 2x if I think copper's going to $10 a pound? Well, then I should think it's going 5x, you know, another, you know, like it's going to keep rising. And then you get caught in the ride it up and ride it back down trap. If I'm instead looking at it and saying, well, this project, it makes money at $2.50 a pound copper. We're here at $4 a pound copper. If copper goes to 10, I'm going to do great with this investment. But if copper falls back to 250, well, you know, I've got to make sure that this project and this investment can be stress tested at these lower levels. So we don't have any durable competitive advantage, as Sam mentioned, in predicting the macro stuff. We have opinions, but those opinions, everybody's got them, and those are biases, and that's not what our skill sets are. Our skill sets are in understanding which projects have the lowest quartile operating costs, or should have the lowest quartile operating costs based on the grade, the tonnage, the location and proximity to infrastructure. Those are the things that we spend a lot of time thinking about, and less time thinking about, is gold going to break through this resistance level, or that it's a real coin toss, in my opinion. And so I stay clear of that sort of thinking.
Okay. I mean, listen, I think that's it's practical in a way where you focus on the things that you can control, right?
Totally.
The idea of trying to guess where commodity prices are going, it's, you're speculating, sure, but
Sure.
In this case, there's a way to kind of, I guess, separate that bias, like you said, because that bias can kind of keep taking you down that road that might not be the best for your portfolio to make smart decisions. Having said that, with gold being at the price it's at, and you mentioned copper, and by the way, there's a copper echo chamber too, and
Totally.
I think Robert Friedland helps make it nice and loud and interesting, and again, it's same fundamentals as uranium. There's supply demand issues. We're running out of reserves, and demand is growing, but the general market is still not in because it's risk off, right? So I think those are really interesting and important reminders that, for whatever reason, you don't hear a lot of the stock gurus and kind of the stock influencers talk about. Now, you mentioned something about the fundamentals of the companies. How early stage will you guys go with regards to a company? I mean, you can go pretty early.
We've done privates. Yeah, we've done private,
Yeah.
Already. Yeah, we've done privates. We have to have a pretty comfortable, like understanding from management that they don't intend on staying private. Their goal is to ultimately go public, but we're getting.
But I mean the stage of the project.
Sure. Yeah, the stage of the project. But we need for there to be an ore body or discovery hole. We're not, you've heard the moose pasture expression. You're in East Africa, it's kudu pasture. If you're in, Peru, it's alpaca pasture. But then it's the truth of the matter is there's so many of these targets. They look great. But we won't really step into something until we see some drill holes that confirm that there's a discovery here. Yeah.
You don't.
In saying that though, we might go 1 or 2 drill holes in, if it looks interesting enough.
Yeah.
We still, and we'll position size according to the risk, right? If you've only got 1 or 2 holes, we're not going to put 5% of the fund in a very, very early stage opportunity. But if something looks genuinely, I mean, genuine tier 1 or even solid tier 2 discoveries are so rare these days that if something looks like it has the potential to fit those categories, we will look to sort of average into an opportunity that looks spectacular.
Yeah. So I want to wrap this up, but before doing so, we talked a lot about different things here about obviously the fund, about companies and investing strategies. Where we are now in the market, and with everything coming at us, talk of recession, talking about more hikes, talking about dropping rates, could go in so many different directions.
Sure. Yeah.
It's a good reminder that focusing on deals is the way to go, and it's the only way to kind of protect yourself from the volatility of headlines and macro events. Can you either, if you want to take turns, or if one of you guys want to take this, maybe just provide your reasoning as to why you think an investor should consider this fund, investing in the Sprott RED LP, and the benefits of doing so. And by the way, we've created a microsite where you can actually learn more about the fund, and you can actually sign up to set up a meeting with your team. And the URL is privateplacements.com/Sprott. We'll have it on the screen and in the comment section. But if you guys can just give us kind of the reasons why someone should invest in the fund, that'll be great.
Sam, why don't you go first?
Yeah, I mean, if you are a investor in the sort of smaller mid-cap natural resources space, and you are accredited or qualified and interested in doing private placements, the fund is definitely something you should consider for a number of reasons. Primarily if you want access to the world's, we like to consider ourselves as the world's premier outfit in this space. It's all we do. We're a niche asset manager. This is our bread and butter, with the best mining experts in the world. It really does. A phrase you used earlier was simplify the whole process. I mean, for those of you listening that have done private placements a la carte, you'll know that there's a whole lot of paperwork, legend removal forms. It is a process.
It's a pain in the ass, Sam. It's a pain in the ass.
I was you've used a little more colorful language than I was going to use, but it is a pain in the ass, especially if you're a US investor. If you want to get the expertise, all the decision making done for you by true experts and make the whole process simple, this really is a no-brainer. I mean, to me, that would be the number one reason to consider coming into this fund. Eric, do you have anything you want to add?
Well, I'd speak to the team that manages it. So we're a group of 5 senior brokers and our resident in-house geologist here in Carlsbad. But we're really kind of at this junction internally here at Sprott, where we see so much in the way of information, about what projects are being advanced and what quality is rising to the top. And at the same time, we see so much in the way of deal flow because of that Sprott brand. Companies want us on the register. They want to be able to boast that, hey, Sprott's a shareholder too. To an average investor, that can kind of be seen as a tick in the box of the due diligence. Well, Sprott has done this. There's a likelihood that they've satisfied their level of due diligence, and this kind of many hands make light work. Thinking of with the whole full force and weight of the Sprott organization, trying to scour the globe looking for great deals. There's no way any individual person can possibly come close to the level of due diligence we're doing, and being able to transact. And you kind of made mention this, Arash, like it's a full-time job, can take a week to research a private placement. That's true, and we have to distill that sometimes down into a span of a couple of hours, because the books get built so fast on these great projects. And especially the ones that are, over in Australia, where we're kind of being asked to reflect in, we're in California time, so maybe the deal goes up at 4 o'clock, our time, and we've got to reflect in by 6 p.m. There aren't enough hours in the day for most individual investors to go out and do the level of due diligence required to be in that space. But like anything else, division of labor is such an important part of our society. This is our bailiwick, as Sam said. It's a Venn diagram of just this. It's complementary to the rest of the commodity landscape of the capital that Sprott is managing, and in that universe, we have our finger on the pulse of this market. So that's the selling point in a nutshell.
I would just add one last thing as well. I mean, we eat our own cooking too. So every single member of the IC has made personal investments in this fund. We talked about internal ownership for management of companies earlier. We do eat our own cooking with what we do too. So we're all invested alongside our LPs.
Yeah, I think, for me, talking to you guys, a lot of what we talk about, it's relatable because I experienced it myself, and I think the expertise, it's very important. I think the access is very important, maybe even more important than the expertise. And Sprott, as you guys mentioned, for those who don't know, Sprott is one of the names in natural resources investing. It's a global asset management company. It's known for its place in the mining universe. And last but not least, if you want to take private placement investing serious, which you should, because it's a way for, and maybe you guys can't say this, but I can. For me, it's been a way to make serious money. Then you got to do it, and to do it properly, it is a full-time job. And unless you don't have a full-time job, it's going to be really, really hard to pull off. So love what you guys are doing. Been a big fan, and always great to chat with you. Appreciate the time, and hopefully chat with you again soon in the near future.
Yeah, we appreciate you, Arash. Thanks for giving us an opportunity to present this to your audience. Thank you.
Yep, cheers, mate.